and welcome to the May Buy-to-Let Mortgage Market Update. My name is Richard Pennell. I'm from The Mortgage Home, and we are your buy-to-let mortgage experts. In this month's update, I've got 4 topics. As always, what's happening with the Bank of England interest rates and, of course, implications with mortgage rates. Some real breaking news from capital allowances. If you're a holiday let owner or short-term letting owner, then you must listen to this. We've got some breaking news from the government to share with you. Now, if you are a landlord that has mortgages that are tied in and you think you can't access the equity, then I've got 5 top tips for you guys. So do listen into that section if you want to keep building, growing your portfolio, but think you're hampered because you're tied in with redemption penalties. And finally, protecting your rental income. If you are a landlord that absolutely 100% relies on the rental income, you might say, well, don't we all? But particularly if it's your only or main source of income, what if that was to stop? What if the tenant doesn't pay? What's in place to help you as a landlord as a safety net? If that keeps you awake at night, or you're a little concerned about that scenario unfolding, then listen to that last section. So in this piece, I want to talk about our market watch and what's going on with interest rates. So I'm recording this on Tuesday, the 14th of May. So last Thursday, the Bank of England met, all 9 of them, and not surprisingly, we all expected this, they kept interest rates yet again at 5.25%. So of course, there's been a clamour now for a few months from various people, third parties, media, financial institutions, to try and put pressure on the Bank of England to put rates down. What is happening for the first time is that we actually have committee members at the Bank of England voting for a rate drop. So that is new that's happening out there. So that's good news. But still, it's not happening. So when will the climate be right? When will the Bank of England be dropping rates? Because obviously the knock-on effect is that mortgage rates should also go in the same direction. Now, what do I know? I'm not privy to what's going on with the Bank of England and what they're thinking. However, what I have been saying all year, and I'm going to be consistent with that message, is all around inflation and where that needs to be at before the Bank of England press the button. Now, we're at 3.2% now. The Bank of England target is 2%. So we're heading there. We're not far off. And I would expect over the next month, maybe 2 months at the most, for inflation to drop below 2%. So you say, oh, brilliant, fantastic, we're there. Let's see these mortgage rates dropping. But here's the thing. That's not going to happen, because what will happen with inflation at that point is it's going to rise again. So I've said this before, when we start to see inflation rising, we will get the crazy headlines. Ignore those headlines. It is a blip. It's a bump in the road. This is what's going to happen. Inflation in Q3 is my prediction, will rise from under 2% to above 2%. It will peak under 3% and it will start dropping again. And it's at that point that I think the Bank of England will take the view, as long as they can have the confidence that inflation will then consistently drop back towards the 2%. I do not believe that after that bump in the road, we have to be hitting the 2% for the Bank of England to press the button. The Bank of England, I believe, will want just the confidence that that blip is over and done with and we're back down the other side, and they see the trajectory heading towards the 2%, then I think they'll press the button. And I believe that'll be in Q3 of this year. So there you go. Now, what's the impact, therefore, with mortgage rates? Because, yes, rates have been going up in the last 6 weeks, which I will comment on in a second. But I believe in terms of mortgage rates dropping, we may well see mortgage rates dropping before the Bank of England actually press the button, because the Bank of England only meet every 6 weeks. And if those conditions are now looking right, if that scenario I've just described, where we've got over the bump in the road and inflation's dropping back down towards the 2%, and we can all see that, then I would expect the banks to come off the fence and start dropping rates before the Bank of England actually get to meet to make their decision. So I would expect mortgage rates possibly to be dropping in Q3 as well. And therefore, as long as that's continuing, I would expect further mortgage rate drops in Q4 of this year. So a 0.5% drop in rates, maybe even 0.75% in that sort of region by the time we get to the end of this year. And that I would hope to see continuing in 2025. So that's my forecast. But just really briefly, we've actually seen mortgage rates rising. So I just want to touch on that. Again, if you listen to and watch the headlines, you would think it's the end of the mortgage world, that rates are going exponentially higher. And that is absolutely crazy, ridiculous. What we've seen is a slight, simple correction by the markets and hence by the main banks and building societies. That correction's happened. It's over. And we're now just sat on a plateau waiting for that scenario I've just painted a few minutes earlier. In terms of rates rising, as a broker, I've seen rates rising about between 0.1 and 0.3%. So again, nothing massive, nothing major. And I do not expect to see it repeated. So we as landlords should all be quite reassured by that. And again, please ignore the headlines. In terms of a takeaway message, look, I said it last month, and I'm going to repeat myself here because I think this is important. Because I firmly believe that mortgage rates are going to be dropping possibly in the next quarter, then if you have to make that decision now because you're on a standard variable rate already, then okay, you've got to make your decision. But leaning towards a 2-year fix rather than a longer term 5-year fix is really compelling, I would suggest. So be looking and be thinking about taking the 2-year deal, because in 2 years' time, we should absolutely see mortgage rates have dropped significantly so that you can then access those lower rates in 2 years. Whereas if you jump for a 5-year deal right now, then your hands are tied pretty much for that longer period of time. So I'm not saying you have to take the 2-year deal, but it must be on the table as an option to speak to your broker about the pros and cons. And if you want to chat that a little bit more through about your circumstances, your situation, there'll be a link at the end of this piece to our online diary. Book some free time on there and have a personalized chat with the team so that you can get that right information and you're in an informed place to make a decision. In this piece, I want to talk about capital allowances. It seems to be my favorite topic. I've talked about it in March, again in April, and here we are in May. A brief recap for those that don't know what on earth capital allowance is. The best way to describe it is to actually give almost a little mini case study about one of my properties. So I've got a 3-bedroom cottage that I use as a holiday let. It's within a limited company. And I paid a surveyor to do a specific report that produces what the capital allowances would be on that property. And the figure was roughly £50,000. Now, I make about, on average, £12,000 of profit from that one property each year. So if I didn't have any capital allowances to claim, I would be paying corporation tax on that 12,000 quid, which is about 2,300 roughly. Because I've got the capital allowance report, I give that report to the accountant, and what they can actually do is reduce the profit essentially notionally from 12,000 down to 0. So I pay no corporation tax whatsoever. And that 2,300 I would have paid to HMRC goes into my pocket. Happy days. Now, the dilemma has been, if we now bring it back to the government, because the government essentially are scrapping capital allowances. That was the bad news I talked about in March and again in April. But they said they're scrapping it from April 25. So what we didn't know was whether, in my example, where I've got this 50,000 of capital allowance, I've only used it for 1 year. So I've got 4 unused years. And if they're scrapping capital allowances in April 25, does that mean I'll not be able to access and use the capital allowances again? So the great news is the government have now finally given us some detail, and they've said that any existing claims or new claims that are put in from now but before the 5th of April next year will be honoured and allowed to continue. So I can continue to keep claiming capital allowances for another 4 years and keeping that £2,300 of corporation tax in my pocket. So here's what you guys should be doing. If you've been sat on the fence as a holiday let owner, serviced accommodation owner, and maybe to a lesser extent a HMO owner, because there can be capital allowances that you guys can claim as well. If you've been sat on the fence thinking, well, what's the point in paying a professional surveyor for me not to be able to claim? We now know we can. So, look, if you know a professional capital allowances surveyor, then go and contact them. Get off the fence. Get them to produce that report so that you know what that allowance is, and then you know whether to make that payment to the surveyor. If you don't know anybody, then by all means, contact me. I'm more than happy to put you in touch with the guy that's the surveyor that's sorted my properties out. Just email me. It's RP Romeo Papa at themortgagehome.co.uk. Just drop me a quick email and I'll just put you in touch with a surveyor and they'll produce that report. They produce the report for free. So if the allowance is put, or what, it might even tell you you can't claim, you're not eligible. You need to know that information up front so you can make a decision. If you can claim, they'll tell you what the allowance is, and then you can choose whether to then pay for the report, and then, of course, you can put that claim in. So you've got a window. You've got between now and the 5th of April next year to do that. So please, please, please come off the fence. The final thing I want to say, you might want to make a note of this, is if you are a landlord that has within their portfolio long-term lets. You've never had a holiday let before, but what if you could repurpose one of your properties as a holiday let, and you've been thinking about it? Maybe the figures sort of make sense as a holiday let. Well, now if you can add the capital allowance on top of that and keep all your profit, not pay any tax, perhaps for 5 years like I am on one of mine, then that might make it a very compelling proposition. So have a look at your existing portfolio and see whether any of your existing properties are in that right area to use as holiday let or service accommodation. Then you can also claim those capital hours, hopefully. I'll cross my fingers for you. And in this section, I want to talk about my top tips for how to access the equity from your portfolio when you are still tied in. You may be under the illusion that you can't access the equity until the penalties end. So I want to dispel those myths now by going through my 5 top tips. The first thing is to find out is, when do those penalties actually end? Because you might be under a wrong assumption that it's further away than it actually is. So if, let's say, we are now in mid-May, let's say those penalties actually ended in 3 months' time at the end of August. You do not have to wait until the end of August to start a refinance to release that equity. And you do not have to have that equity released and the money in your bank account before you can put offers in on properties. Many of our landlords will be putting offers in on property now to the estate agent, and you'll be starting a purchase application with a mortgage, and at the same time start a refinance application to release that equity. So you've got 2 applications going on in sync. And as a mortgage brokers, we would be choreographing those 2 applications so that the refinance application completed on the 1st of September, because your penalties end at the end of August. So we manage the refinance so that literally the day after your penalties end and the shackles are off, the mortgage completes and your solicitor gets the funds released to allow them to complete possibly just a couple of days later on the purchase. So the 2 can go in sync, which means you can start looking now. If that offer of a fantastic purchase comes across your desk today, then you can start putting offers in today. You do not have to wait until, like I say, August, September, October, till you start viewing properties. So that's the first thing. But what if the penalties don't end in 3 months? They're in 1 year or 2 years' time. Then what are you going to do? Now, in simple terms, you could pay the penalty. Now, the first thing is, do you know what the penalty is? So, again, make sure you check the figures, check your last mortgage offer so that you know what the penalties are, because quite often the penalties change. They tend to be on a bit of a league table. So they reduce over time. So you might have in your head that the penalties are at 5% of the balance, and actually they've dropped to 4% or 3% of the balance. So it could be lower than you think. That's the first thing. The second thing is, in some ways, let's say your penalties are £5,000. Who cares if you've got an opportunity to buy a fabulous property with a 10 or 15 or £20,000 discount? Okay, if it costs me an extra £5,000 to get out of my deal, but there are ultimately savings to be had because I'm getting such a discount on a property, or I can add value to a property I'm looking to buy that covers those costs and still gives you a discount, a net discount or a profit, then you're still going to do it. So what I'm saying is, get the information. Don't just take a simplistic view that if you've got a £5,000 penalty, oh, I'm not paying £5,000 to a lender. You've got to look at it in context, of course, of what the benefits are and what the costs are, and take an informed decision. So that's my second point. This third point is, I'm still surprised on a regular basis to when I'm having conversation with landlords and I say, have you considered a further advance? And the answer I get back is, what's a further advance? Most lenders offer this facility. And what it essentially is exactly for the circumstances we're describing, where you're tied in with lender A for another 2 years, but you've got equity and you now need to access it to continue to build your portfolio. So the lenders don't want to miss on that opportunity to make more money from you. So they offer a mini mortgage. This further advance is a mini independent mortgage that sits on its own. It's got its own mortgage product. It's got its own interest rate. There might be a little setup fee, but it stands alone, separate from the main mortgage. And so that allows you to then access that equity. So you've got to contact your existing lender, or you go via your broker who will do that for you, and have a conversation with the bank or the lender to understand whether you are eligible. It's not a divine right. You have to be eligible. It's like it's like an application. They'll do an assessment on you, and they'll do stress tests about what the rental income is, what the value is, what the equity is, and they'll tell you if you're eligible for and how much you can possibly release. So further advance is a fantastic option, and most lenders have that facility. Now, what if, one, they don't have that facility, or two, when you've gone through that process, your current lender says, yeah, you're eligible, but we're only going to lend you 5,000 quid, which might not be what you want when you've got potentially, you think, 10, 20, 30 grand's worth of equity tied up. So here's the next option, a second charge. So it's just like what I've described, but it's with an independent lender. It's with another lender or institution for this mini mortgage. Now, quite often the rates are slightly higher than a further advance, but here's the thing. You've got more lenders' doors to knock on. You've got more opportunities. So therefore, quite often they are more generous. So if the issue is that the current lender for a further advance will only lend you a few £1,000s, but you go to a second charge lender and they'll lend you what you want, yes, the rate's a little bit higher, but it still makes sense to release that money because of the benefits, then second charges might just be for you. So contact your broker. They will do that research. They will tell you if there are second charge lenders out there, whether you're eligible, and how much you could lend. And then the last thing is joint venture finance. Now, people might be a little nervous about this. Maybe they've never used it before, but it's an umbrella heading that could actually mean contacting family, close friends, people that have trust in you and know what you're doing. You've got a track record with properties. And so, why wouldn't they lend you the money? You're going to pay them perhaps a rate of interest back that they would be getting higher than they would in a bank. So it makes sense for all parties. So joint ventures could be as simple as I said, dealing with family and friends, but it also could be with other business partners. And I guess it is knowing how to access those people. But there are property education companies out there that'll do many courses on what joint ventures look like, how to access these people, how to have conversations with them, what template agreements to put in place. And so there's a lot of information, content, learning education out there to get you the knowledge to have the confidence to have conversations on joint venture basis. The thing I would say that's really important, and again, you might want to jot this down, is that if you are thinking of entering into a joint venture finance to access money to use as deposits for a purchase, then speak to your broker, because there's lots of hoops to jump through. There's lots of rules and policy clauses about use of money where it's come from people that are not family members. So before you lend that money from a joint venture partner and then come to your broker to use a deposit, speak to your broker up front. Explain to them what that joint venture might look like, and your broker will say what lenders have got appetite to lend, or maybe you've got to structure it slightly differently. And that's really, really valuable, because then you can put that into your negotiation with your joint venture partner. So bring your broker involved in that conversation sooner. So look, if you're thinking of exploring any of these tips, any of these options, if you've got equity tied up and you want to walk through those 5 tips, then, and you don't have a broker, then talk to us. There'll be a link at the end of this piece. Book some free time in, and we're more than happy to review your portfolio, look at what equity you can access, and look at all these options. In this piece, I want to talk about protecting your rental income. Now, we want 100% of the rental income coming in 100% of the time. Is that being greedy? No, as landlords, of course, we always want that to happen. But life gets in the way, and sometimes the rental income just doesn't come in. And the worst that can happen is when you're checking that bank statement and that tenant hasn't paid you. You get that horrible feeling in the pit of your stomach. Are they just going to pay us tomorrow, or is it something more sinister that's going on? Look, I've been a landlord for 25 years. Twice the worst has happened to me, where the tenant has not paid month on month, and despite dialogue, despite conversation, despite false promises, it just isn't forthcoming. And I've then had to take that reluctant decision to go through the eviction process. And it's even led to courts, because despite you serving the notices, they still haven't moved out. So you've got to go through the court process. And then you've got to go through bailiffs, and eventually they leave the property. That, to me, is one of the worst case scenarios you could come across as a landlord. So, look, if you're one of those landlords that absolutely relies on the rental income, and by that I mean it's your main or only source of income, so you can't afford for a tenant to not be paying you that 1,000, that 1,500, that £2,000 a month. Look, if you've got a property down in the southeast, then having rental income of 2 to 3K a month is quite normal. And if that, what would be the implications if that stopped coming in? Now, okay, if you've got a lot of savings to fall back on, then that is your insurance policy. But what if your savings are modest? What if you don't have savings and you're relying on that rental income to pay your own bills? Then you must be listening to this piece and taking some action here, because there are insurance policies out there to protect you, to mitigate that risk, so that you don't have the sleepless nights. And you should be considering these. So you might be thinking, oh yeah, but what's the price? Is it prohibitive? Well, this is how it works. So you can put the insurance policy in place should that tenant doesn't default on paying their rental income. Once they've not paid the rental income, there's a month excess period. So we're getting into month 2. If that continues, then you can trigger the insurance claim. You can claim up to about £2,500 a month. And the premium, here's the thing, the premium is going to be no more than about £15 to £20 a month. Now that's to cover up to £2,500 of rent. And the insurance will continue to pay you your rental income until the tenant, look, if the tenant eventually starts paying again, happy days. But let's assume that's not going to happen. So the insurance policy continues to pay you rental income month on month on month until you get vacant possession. The insurance policy will also pay all the legal costs, all the costs associated with solicitors and with the court process to get that tenant evicted. And once eventually you've got vacant possession, then the claim stops at that point. So look, if that gives you peace of mind, if that allows you to sleep at night, then you should really be considering that type of policy. And here's another scenario. I used to manage the properties myself. I don't now. I've sort of wised up and given it to people that are far better at it than I am. But back in the day, I would interview, I'd do all the advertising and interview the tenants myself. And sometimes you didn't have queues of tenants going down the road. You were a little short on options, I guess, of who you'd accept as a tenant. And you're sometimes a little bit desperate because you've got an empty property and you've got this potential tenant in front of you. And your head is saying, sign them up, get the money in. But your gut is telling you something different. And your gut might be saying, there's something I can't quite put my finger on here with this tenant. And so that because there's no relationship with that tenant, there's no track record with that tenant, what are you going to do? Are you going to say no to them on a gut feel? Might well be right. But here's what you can do. You can get the insurance policy in place so that if your gut was right, you've got the insurance policy there to protect you. But then after a period of months, maybe the first year, you've got to know that new tenant. Maybe your gut wasn't right. Maybe actually you have built that relationship up. They have paid every single month on time. And you've got that connection with your tenant now. Well, then maybe a year down the line, you can stop that policy because you've got a relationship and you trust the tenant and you can continue thereafter. So these policies might be something you just bring in for a short period of time until you get confidence with your tenant. Or, as I said, it might be something you leave in place because at 15 to 20 quid a month, it's a price worth paying, particularly where you landlords, as I said a little earlier, are 100% reliant on that income because it's your only or main source of income for your living expenses. So the takeaway message is, look into it, explore it, get yourself educated about these types of policies, get some quotations on your portfolio or those within your portfolio that you feel either more at risk or have just got new tenants coming in. So again, click on the link at the end of this piece, book an appointment with our insurance advisor, and they'll give you and arm you with all the information you need to make decisions on that. So I hope that's been really useful on protecting your rental income. Finally, this is a list of our services. So if anyone wants to have a more personalized, in-depth conversation about anything that's on this slide, anything to do with finance secured against bricks and mortar, or anything to do with insurance, whether it's life insurance, critical illness policies, income protection, or rental guarantee insurance, then book some time in. There'll be a link under this video to our free online diary. Book some time in with the team, and we'll be delighted to help with your adventures and your portfolio building and making sure that you keep a healthy portfolio in place. So thank you so much for listening and watching our mortgage update, and we'll see you on the next one.